Question 1. A candidate for registration as an associated person has a felony conviction for a non-securities-related crime that occurred 15 years ago. Which of the following is the most accurate statement regarding this individual's eligibility for registration? A. The individual is eligible because the felony was non-securities related. B. The individual is eligible because more than 10 years have passed since the conviction. C. The individual is statutorily disqualified regardless of the nature of the crime or the time elapsed. D. The individual is statutorily disqualified and would need to seek a waiver from FINRA. Answer: D. The individual is statutorily disqualified and would need to seek a waiver from FINRA. A statutory disqualification occurs when an applicant has been convicted of any felony, whether securities related or not, within the last 10 years. Since the felony occurred 15 years ago, the individual is not statutorily disqualified based solely on the time elapsed. However, any felony conviction still requires disclosure on the Form U-4 and may be reviewed by FINRA, which has the power to deny or conditionally grant registration based on a wide range of public interest factors and disclosures, often requiring a formal waiver process. The core concept is that a felony conviction remains a disclosure requirement, and FINRA's determination is not always automatic after 10 years, especially for a complex exam like the SIE. Always remember that a prior felony is a major disclosure item on the Form U-4. Question 2. An investor in the 28% federal tax bracket is considering a municipal bond yielding 4.5% or a corporate bond yielding 6.25%. To determine which investment offers the better after-tax return, the investor should calculate the corporate bonds. A. Tax-free equivalent yield. B. Taxable equivalent yield. C. Current yield. D. Yield to call. Answer: A. Tax-free equivalent yield. The core concept of comparing tax-exempt municipal bonds to taxable corporate bonds requires finding the tax-free equivalent yield for the corporate bond. The investor is trying to see what the 6.25% corporate bond yield is after the 28% federal tax is taken out, so it can be compared directly to the tax-free 4.5% municipal bond yield. To calculate the tax-free equivalent yield, one takes the taxable yield and multiplies it by the complement of the tax bracket, 1.00 minus the tax rate. For example, 6.25% multiplied by 1 to 0.28, or 0.72 shows the true after-tax return of the corporate bond, which is the figure to compare to the municipal bond. Here's an easy way to remember. To go from a taxable yield down to a tax-free equivalent, you must multiply by the remaining percentage. Question 3. A broker-dealer executing a trade for a customer account is acting in a principal capacity when it does which of the following? A. Charges a commission for finding a counterparty and matching the two sides of the trade. B. Charges a markup or markdown on a security it is selling from or buying into its own inventory. C. Facilitates a trade between two institutions by anonymously matching their orders. D. Distributes shares of an initial public offering IPO under a best efforts underwriting. Answer: B. Charges a markup or markdown on a security it is selling from or buying into its own inventory. A broker-dealer acts in a principal capacity when it trades for its own account, meaning it takes the risk of buying the security into its own inventory or selling from its inventory directly to the customer. When a firm acts as a principal, it charges the customer a markup when selling, or a markdown when buying, because it is essentially acting as the counterparty to the trade. Conversely, when a firm acts as an agent, it is simply connecting the buyer and seller, and for this service, it charges a commission. Remember that the term principal in this context is another word for dealer, which takes a position in the security. Question 4. A husband and wife open a joint brokerage account and specify that ownership is to be held as joint tenants with right of survivorship, STROs. If the husband dies, what happens to the assets in the account? A. The deceased share passes to his estate, subject to probate. B. The deceased share is frozen until the wife presents a letter testamentary. C. The entire account automatically transfers to the surviving wife's sole ownership. D. The wife is immediately limited to trading only liquidation transactions until the account is retitled. Answer: C. The entire account automatically transfers to the surviving wife's sole ownership. The core concept of joint tenants with right of survivorship, STROs, is the right of survivorship, which means that upon the death of one account owner, the deceased's ownership interest immediately and automatically passes to the surviving owners. This type of account avoids the probate process, as the ownership transfer is governed by the account agreement, not the deceased's will. In contrast, an account held as tenants in common (TIC) would pass the deceased's share to their estate, making the JSTRO's designation the critical clue in this scenario. For any joint account, a death certificate must still be provided to the broker-dealer to formally effect the transfer of title. Question 5. Which of the following characteristics is unique to open-end investment companies, mutual funds, compared to closed-end investment companies? A. They are actively managed and diversified across various securities. B. They issue a fixed number of shares that trade on an exchange. C. They typically only issue common stock, no debt. D. They stand ready to redeem their shares at the current net asset value, NAV. Answer: D. They stand ready to redeem their shares at the current net asset value, NAV. Open-end investment companies, commonly known as mutual funds, are continuously issuing new shares and are obligated to redeem or buy back their outstanding shares from investors at the current net asset value, NAV. This key feature is why mutual funds are not traded on an exchange. Investors buy directly from the fund and sell back to the fund. Closed-end funds, conversely, issue a fixed number of shares in an IPO, and these shares then trade on stock exchanges between investors, often selling at a price above or below their NAV. The constant readiness to redeem shares at NAV is the defining structural difference between open-end and closed-end funds. Question 6. An issuer is conducting an offering under the intrastate exemption, Rule 147. Which condition must be met for this exemption to apply? A. All purchasers must hold the securities for a minimum of 12 months before selling to an out-of-state resident. B. All purchasers must reside in the state, and 100% of the gross revenues must be derived from in-state activities. C. All purchasers must reside in the state, and the securities cannot be resold to non-residents for 6 months from the date of the sale by the issuer. D. The offering amount must not exceed $75 million, and all purchasers must be accredited investors. Answer: C. All purchasers must reside in the state, and the securities cannot be resold to non-residents for 6 months from the date of the sale by the issuer. The intrastate offering exemption, governed by Rule 147, is designed to permit the sale of securities to residents of a single state without full SEC registration, provided the issuer has its principal place of business and significant business operations within that state. A crucial requirement for the purchasers is that they must all be residents of the state, and to prevent the securities from immediately bleeding into the national market, there is a strict 6-month period during which resales may only be made to other state residents. The key takeaway is that the exemption is built around the intrastate nature, meaning both the issuer's business and the initial sales must be contained within one state for a set period. Question 7. Which security grants its holder the long-term, dilutive right to buy a company's stock at a set price, often issued alongside a bond offering to make the debt more attractive? A. Preemptive right. B. Put option. C. A warrant. D. American Depositary Receipt, ADR. Answer: C. Warrant. A warrant is a long-term option to buy a stated number of common shares at a specified price, called the exercise price, often set above the current market price at the time of issue. Warrants are frequently attached to new issues of bonds or preferred stock to make the primary offering more appealing to investors, acting as a sweetener. In contrast, a preemptive right is a short-term, non-dilutive right given to existing shareholders to maintain their proportional ownership, and an option is a separate contract, not typically issued by the corporation itself to finance its operations. Think of a warrant as a company's long-term promise to sell stock to the holder at a predetermined price in the future. Question 8. An individual applying for registration as an associated person, completing Form U-4, must disclose which of the following events, regardless of the time elapsed? A. A misdemeanor conviction for reckless driving 15 years ago. B. Any customer complaint that was settled for less than $5,000. C. Any charge or conviction related to a felony. D. Personal bankruptcy filed more than 10 years ago. Answer: C. Any charge or conviction related to a felony. The Form U-4, which is the Uniform Application for Securities Industry Registration or Transfer, requires the disclosure of a broad range of events related to the applicant's criminal, regulatory, civil, and financial history. A crucial, non-time-limited disclosure requirement is any charge or conviction related to a felony or certain securities-related misdemeanors, as this information is vital for FINRA's determination of an individual's fitness for registration. While a felony conviction only results in a statutory disqualification for 10 years, the fact of the charge or conviction itself must be disclosed in perpetuity. The key is to remember that the U4 requires disclosure on all felony charges, not just those resulting in a conviction regardless of time. Question 9. An investor who owns 1,000 shares of XYZ stock currently trading at $50 per share wishes to generate income and reduce the cost basis of the position. Which option strategy would be most appropriate? A. Buying a put option. B. Selling a covered call option. C. Selling a put option. D. Buying a call option. Answer B. Selling a covered call option. Selling a call option against stock that the investor already owns is known as a covered call strategy, and it is a conservative income-generating technique. The investor receives the premium from selling the call, which immediately reduces the net cost basis of the stock position. The risk is that if the stock price rises significantly, the stock will be called away, and the investor will miss out on the appreciation above the strike price. The key clue here is the goal of generating income while reducing the cost basis, which is exactly what receiving a premium from a covered call achieves. Question 10. The fourth market is best characterized as the venue where A. Exchange-listed securities are traded over-the-counter (OTC) by non-members. B. Unlisted securities trade through broker-dealers who act as market makers. C. Exchange-listed securities trade between two institutional investors without the use of a broker-dealer. D. The market for derivative products such as options and futures is transacted. Answer: C. Exchange-listed securities trade between two institutional investors without the use of a broker-dealer. The four main types of securities markets are the first market, exchanges; the second market, OTC/unlisted; the third market, exchange-listed securities traded OTC by broker-dealers; and the fourth market. The fourth market is a venue for direct trading of large blocks of securities between institutional investors, such as mutual funds, pension funds, and insurance companies, often using electronic communication networks, ECNs, to bypass broker-dealers entirely. The central concept is direct, unbrokered transactions between institutional parties. Remember that the defining feature of the fourth market is its direct, institution-to-institution nature. Question 11. A corporate issuer has outstanding shares of 4% cumulative preferred stock. The company's board of directors voted to suspend all dividend payments for the past 2 years. If the company wishes to resume paying dividends, what is the minimum dividend per share the common stockholders will be eligible to receive in the current year? A. 0%. B. 4%. C. 8%. D. 12%. Answer: A. 0%. The term cumulative means that if the company skips a dividend payment, an arrearage, that unpaid dividend accumulates and must be paid to the preferred stockholders before any dividend can be paid to the common stockholders. In this scenario, the preferred stockholders are owed 3 years' worth of dividends, the 2 years missed and the current year, a total of 12%. Since the question asks what the common stockholders are eligible to receive after the preferred shareholders are made whole, and the preferred shareholders are paid the full amount due, there is no mention of an excess dividend amount for the common stockholders. Therefore, the common stockholders are only eligible to receive a dividend if the board of directors declares one after the preferred stock is paid, and the minimum they must receive is 0, as common dividends are never guaranteed. The key concept is that the common stockholders are residual claimants, only receiving payment after all preferred obligations are met. Question 12. Which regulatory body is responsible for enforcing the rules governing the underwriting and trading of municipal securities by broker-dealers? A. The Municipal Securities Rulemaking Board, MSRB. B. The Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA. C. The Federal Reserve Board, FRB. D. State Securities Administrators, Blue Sky Laws. Answer: B. The Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA. The Municipal Securities Rulemaking Board, MSRB, is the self-regulatory organization, SRO, that writes the rules for municipal securities market participants, but it has no enforcement authority of its own. Enforcement of MSRB rules over broker-dealers falls to the Financial Industry Regulatory Authority (FINRA), while the Securities and Exchange Commission (SEC) retains ultimate oversight and enforcement power over all market participants. The Federal Reserve Board (FRB) focuses on monetary policy and margin rules, and state administrators enforce state laws. Remember that for broker-dealers, MSRB writes the rules, but FINRA and the SEC enforce them. Question 13. The primary distinction between the regulatory function of the Securities and Exchange Commission (SEC) and the Financial Industry Regulatory Authority (FINRA) is that a. The SEC oversees new offerings, while FINRA is responsible for secondary market trading. b. The SEC writes federal securities laws, while FINRA acts as a primary SRO responsible for rule enforcement and broker-dealer examinations. c. The SEC sets margin requirements, Regulation T, while FINRA is responsible for anti-fraud rules. d. The SEC focuses on disclosures to the investing public, while FINRA solely focuses on the conduct of corporate issuers. Answer: B. The SEC writes federal securities laws, while FINRA acts as a primary SRO responsible for rule enforcement and broker-dealer examinations. The Securities and Exchange Commission (SEC) is the federal government agency that enforces federal securities laws, sets regulatory policy, and is the ultimate regulator for all market participants. FINRA is the largest non-governmental self-regulatory organization, SRO, and is responsible for writing and enforcing rules governing the conduct of its member broker-dealer firms and their associated persons, including examination, registration, and disciplinary actions. The core distinction is that the SEC is the government regulator with broad authority over the laws, and FINRA is the industry SRO responsible for day-to-day regulation of broker-dealers. Think of the SEC as Congress and FINRA as the police force for broker-dealers. Question 14. An investor purchases an American Depositary Receipt, ADR, of a foreign company. The key risk associated with this investment that is not inherent in a domestic common stock purchase is a. Interest rate risk due to the foreign bond market exposure. b. Liquidity risk due to the lack of an active secondary market. c. Currency risk due to the value of the underlying foreign shares being denominated in a foreign currency. d. Call risk due to the potential for the issuing bank to redeem the ADR. Answer: C. Currency risk due to the value of the underlying foreign shares being denominated in a foreign currency. An American Depositary Receipt, ADR, is a certificate that represents ownership of shares of stock in a foreign company and is traded on U.S. exchanges. While the ADR itself trades in U.S. dollars, the value of the underlying foreign shares is denominated in a foreign currency, meaning the investor is subject to currency risk. If the value of the foreign currency weakens relative to the U.S. dollar, the dollar-based value of the ADR will decrease, even if the foreign company's stock price remains the same in its home currency. The central concept is that the ADR is a proxy for foreign shares, and all foreign investments carry currency risk. Question 15. Which statement is true regarding contributions to a Uniform Gifts to Minors Act (UGMA) or Uniform Transfers to Minors Act (UTMA) account? A. Contributions are tax deductible for the donor, up to an annual limit. B. Only the minor's parent or legal guardian may make contributions to the account. C. Contributions are considered an irrevocable gift, and the minor is the account's legal owner. D. The donor may restrict the use of the funds until the minor reaches age 25. Answer: C. Contributions are considered an irrevocable gift, and the minor is the account's legal owner. A key feature of UGMA and UTMA accounts is that any assets contributed are considered an irrevocable, non-cancelable gift to the minor, meaning the minor is the legal owner of the assets for tax purposes. The custodian manages the account for the minor's benefit, but the donor relinquishes control and ownership immediately upon making the gift. Although the minor owns the account, the custodian controls the assets until the minor reaches the age of majority, or a later age up to 25 for UTMA, depending on the state. Remember the core concept. A gift is irrevocable and the minor is the legal, if not controlling, owner. Question 16. An investor who purchases a corporate bond at a discount and holds it to maturity will realize what kind of income at the time of redemption? A. A capital gain. B. An ordinary income gain. C. A tax-exempt gain. D. A phantom income gain. Answer B. An ordinary income gain. When a bond is purchased at a discount in the secondary market and held to maturity, the difference between the purchase price and the par value, face value, is considered part of the bond's return. This discount accrual must be treated as ordinary income for tax purposes, as it is viewed as an additional form of interest earned, rather than a capital gain. Conversely, if a bond is purchased at a premium, the premium must be amortized, reducing the taxable interest income each year. The clue is purchased at a discount and held to maturity, which triggers the ordinary income tax treatment on the discount amount. Question 17. Which communication would be categorized as a retail communication, and thus require principal pre-approval before first use? A. A customized letter sent to a single institutional investor. B. A research report made available only to registered representatives within the firm. C. A prospectus filed with the SEC regarding a new public offering. D. A firm's website or social media post promoting its investment services to the general public. Answer: D. A firm's website or social media post promoting its investment services to the general public. FINRA defines retail communication as any written or electronic communication distributed or made available to more than 25 retail investors within any 30 calendar day period. A firm's public website or a post visible to the general public is clearly distributed to more than 25 retail investors, thereby requiring principal pre-approval before first use to ensure fair, balanced, and non-misleading content. A customized letter to one institutional investor and internal research reports would not meet the retail communication threshold. Always remember that any communication reaching the general public must be reviewed and approved by a qualified principal. Question 18. In the over-the-counter OTC market, a market maker posts a quote of 15.00 to 15.25, 5 by 10. What does the number 10 represent in this quote? A. The number of round lots, 100 shares, the market maker is willing to sell at $15.25. B. The number of shares the market maker is willing to buy at $15. C. The current total trading volume of the security that day. D. The minimum price fluctuation for the security. Answer: A. The number of round lots, 100 shares, the market maker is willing to sell at $15.25. A market maker's quote is always presented as bid-ask size, where the bid is the price the market maker is willing to buy the security and the ask or offer is the price the market maker is willing to sell. The size of the quote is presented as bid size x ask size, with the sizes representing the number of round lots, 100 shares, the market maker is firm for. Therefore, the quote 15.00 bid, 15.25 ask, 5 by 10, means the market maker is firm to buy 5 round lots, 500 shares, at $15 and sell 10 round lots, 1,000 shares, at $15.25. The number 10 represents the 1,000 shares available for sale at the ask price. Question 19. Which of the following is an essential characteristic of a money market instrument? A. It is a long-term debt instrument with a maturity of over 1 year. B. It is highly liquid and has a short-term maturity of 1 year or less. C. It is generally subject to significant price fluctuations due to interest rate risk. D. It can only be purchased by large institutional investors. Answer: B. It is highly liquid and has a short-term maturity of 1 year or less. Money market instruments are high-quality, short-term debt securities issued by corporations and governments, such as Treasury bills, commercial paper, and certificates of deposit, CDs. Their essential characteristics are high liquidity, low risk, and a maturity of 1 year or less, making them easily convertible to cash with minimal impact on price. Because they are short-term, their prices are less volatile than long-term bonds, meaning they are less exposed to interest rate risk. The key concept is that the money market is for short-term financing and investing. Question 20. An employee of a broker-dealer receives material, non-public information about a potential merger from an insider. If the employee trades on this information, which federal law is primarily being violated? A. The Securities Act of 1933. B. The Investment Company Act of 1940. C. The Securities Exchange Act of 1934. D. The Sarbanes-Oxley Act of 2002. Answer: C. The Securities Exchange Act of 1934. The Securities Exchange Act of 1934 governs the secondary trading of securities and contains the principal anti-fraud provisions of the federal securities laws, including those that prohibit insider trading. Specifically, Rule 10b-5 under the 1934 Act prohibits fraudulent activities in connection with the purchase or sale of any security. The core concept is that insider trading is a violation of the anti-fraud rules that maintain the integrity of the secondary market, which the 1934 Act regulates. Remember that the 1934 Act regulates people and places in the secondary market, which is where insider trading occurs. Question 21. Under Regulation Best Interest, Reg BI, a broker-dealer is required to establish and enforce policies and procedures reasonably designed to ensure that it has a reasonable basis to believe that a recommendation is in the best interest of a retail customer. This requirement is known as the A. Disclosure obligation, B. Care obligation, C. Conflict of interest obligation, D. Compliance obligation. Answer B. Care obligation. Regulation Best Interest, Reg BI, establishes a heightened standard of conduct for broker-dealers when making recommendations to retail customers, and this standard is fulfilled through 4 primary obligations. The care obligation specifically requires a broker-dealer to exercise reasonable diligence, care, and skill to understand the potential risks and rewards of a recommendation and have a reasonable basis to believe that the recommendation is in the customer's best interest. The other obligations address disclosing conflicts, eliminating certain conflicts, and ensuring compliance, but the recommendation requirement is the care obligation. The key takeaway is that the care obligation is essentially the new higher standard of suitability under Reg BI. Question 22. Which type of security is designed to perform the opposite of the market or an index and often employs leverage, making it generally unsuitable for a retail investor's long-term buy and hold strategy? A. Exchange-traded fund ETF. B. Inverse and leveraged ETF. C. Real estate investment trust REIT. D. Index mutual fund. Answer B. Inverse and leveraged ETF. Inverse exchange-traded funds ETFs are designed to profit from a decline in the value of an underlying index, and leveraged ETFs aim to deliver a multiple of the daily returns of an index. Both types are often reset daily, meaning their performance over longer periods can significantly deviate from their stated objectives, making them highly complex and generally unsuitable for retail investors with a long-term time horizon. The key clue is the security that is designed to perform the opposite of the market and uses leverage, which immediately points to this category. Due to their complexity and daily compounding, these products are best suited for sophisticated, short-term trading strategies. Question 23. What is the key difference in compensation structure between a broker-dealer, BD, and an investment advisor, IA? A. BDs charge commissions for effecting transactions, while IAs charge fees for investment advice. B. BDs charge a flat fee for all account activities, while IAs charge transaction-based commissions. C. BDs must register with the SEC, while IAs only register with state administrators. D. BDs manage discretionary accounts, while IAs are strictly prohibited from holding customer funds. Answer A. BDs charge commissions for effecting transactions, while IAs charge fees for investment advice. Broker-dealers, BDs, earn commissions when they execute transactions in an agency capacity, or markups/markdowns in a principal capacity, and their primary business is trading and underwriting. Conversely, an investment advisor IA provides investment advice as a primary business and is typically compensated through fees, often based on a percentage of the assets under management, AUM. The core distinction between the two roles under the Securities Acts rests heavily on how they are compensated and what they are primarily in the business of doing. Remember that commission equals broker-dealer, and fee equals investment advisor. Question 24. How are U.S. Treasury bonds and notes typically quoted in the secondary market? A. As a percentage of par in 32 NDS of a point. B. As a percentage of par in 8 THS of a point. C. In decimal format based on an annual yield. D. As a percentage of par in 100 THS of a point. Answer A. As a percentage of par in 32 NDS of a point. U.S. Treasury notes and bonds, which are long-term debt securities, are traditionally quoted in a fractional form based on 32 NDS of a point, where a point equals 1% of the $1,000 $1,000. Par value or $10. $10. For example, a quote of 101 to 16 means 101, 101, and 16 slash 32, 16 of 32, or $1, 15.00, $1,015. This fractional quoting method is a historical standard for government bonds and is a core piece of SIE knowledge. In contrast, corporate bonds are typically quoted in 8 THS, and municipal bonds in 8 THS or decimals, while Treasury bills are quoted on a discount yield basis. Question 25. Under Regulation D, an accredited investor is an individual who meets which of the following criteria? A. Has at least $500,000 in liquid net worth, excluding primary residence. B. Has a gross income of at least $200,000 in each of the 2 most recent years, or $300,000 with a spouse, with a reasonable expectation of reaching the same level in the current year. C. Has held a Series 7, 65, or 82 license for at least 2 years. D. Is a corporate entity with assets exceeding $5 million, regardless of the type of investment. Answer: B. Has a gross income of at least $200,000 in each of the 2 most recent years, or $300,000 with a spouse, with a reasonable expectation of reaching the same level in the current year. Regulation D provides an exemption from full SEC registration for private placements, provided the securities are primarily sold to accredited investors. For an individual, one way to qualify as an accredited investor is to meet specific income thresholds. An annual income of at least $200,000, or $300,000 jointly with a spouse, for the past 2 years, with the expectation of meeting it again in the current year. Other ways to qualify include having a net worth of over $1 million, excluding the primary residence, or holding certain professional certifications. The key concept is that accredited investors are deemed financially sophisticated enough to evaluate the risks of unregistered offerings. Question 26. Which piece of information is required to be obtained from a new customer before the customer's first trade is executed, according to anti-money laundering (AML) regulations? A. Investment objective and risk tolerance. B. Name, physical address, and date of birth. C. Employment history for the past 10 years. D. Total annual income and net worth. Answer B. Name, physical address, and date of birth. FINRA rules require that a registered representative obtain essential information about a customer, and the Anti-Money Laundering (AML) compliance program, specifically the Customer Identification Program (CIP), mandates that a broker-dealer verify the identity of any person opening an account. The minimum information required to open the account includes the customer's name, physical address, date of birth, and taxpayer identification number, usually a social security number. While suitability information like objectives and net worth must be collected promptly, the CIP information is required before the account can be formally opened and the first transaction executed. Question 27. Following a disciplinary action, an associated person who wishes to appeal a FINRA hearing panel's decision must first submit the appeal to the A. Securities and Exchange Commission, SEC. B. National Adjudicatory Council, NAC. C. Federal Reserve Board, FRB. D. State Securities Administrator. Answer B. National Adjudicatory Council, NAC. FINRA's disciplinary process provides an internal hierarchy for appeals. If a registered person or firm is found to have violated rules by a FINRA hearing panel, the first level of appeal within FINRA is to the National Adjudicatory Council, NAC. After the NAC renders a decision, the next level of appeal is to the Securities and Exchange Commission, SEC, and subsequent appeals can be made to the federal courts. The key clue is the request for the first appeal after the hearing panel's decision, which is always the NAC. Question 28. A securities registration statement is filed with the SEC on June 1st. The effective date for the offering is June 21st. The period between June 1st and June 21st is best described as the A. Post-effective period. B. Cooling off period. C. Primary market period. D. Quiet period. Answer B. Cooling off period. The Securities Act of 1933 governs the primary market, which includes the public offering process. The period after an issuer files the registration statement but before the SEC declares the registration effective is known as the cooling-off period, which must last a minimum of 20 days. During this time, the underwriter can distribute a preliminary prospectus, red herring, and collect indications of interest, but no sales or offers to sell can be finalized. The key concept is the time between filing and effectiveness, which is designed to allow investors and the SEC time to review the details. Question 29. The debt service for a general obligation municipal bond is primarily secured by A. User fees and tolls collected from the project being financed. B. The full faith and credit of the issuing municipality, backed by its taxing power. C. Lease payments made by the corporate entity using the financed facility. D. An escrow account containing U.S. government securities. Answer B. The full faith and credit of the issuing municipality, backed by its taxing power. General obligation bonds are municipal bonds issued to finance non-revenue producing projects like schools, police stations, or roads. The principal and interest payments, debt service, are backed by the full faith and credit of the issuer, which primarily means the issuer's power to levy and collect taxes, such as ad valorem, property taxes. In contrast, a revenue bond is secured only by the revenues generated by the project it funds, such as tolls or utility fees. The critical difference is the source of payment, tax revenue for bonds. Question 30. FINRA rules state that a municipal securities principal must approve a new customer account. A. Before the settlement of the first transaction. B. Immediately after the first transaction. C. Within 7 business days of the first transaction. D. Within a reasonable time after the initial transaction. Answer: D. Within a reasonable time after the initial transaction. According to FINRA and MSRB rules, a qualified principal must approve all new accounts. The rules allow this approval to occur promptly or within a reasonable time after the completion of the first transaction. The reason for this allowance is to permit registered representatives to open and execute the initial trade in a timely manner. However, the representative must still have diligently obtained all required new account information before the first order is entered. The key is that the rule requires the opening of the account before the first trade, but the principal approval can follow shortly thereafter. Question 31. An investor purchases one XYZ May 50 call option for a premium of $3. What is the maximum loss the investor can incur on this position? A. The strike price of the call, $5,000. B. The difference between the strike price and the current market value. C. The entire stock price if the stock goes to zero. D. The premium paid, which is $300. Answer: D. The premium paid, which is $300. The core concept of a long option position, whether a call or a put, is that the maximum loss is limited strictly to the premium paid for the contract. By purchasing the call option, the investor paid a premium of $3 per share, which for one contract representing 100 shares, is 3 times 100 equals $300. 3 times 100 equals $300. If the option expires worthless because the stock price stays below the $50 strike price, the investor loses only the premium and nothing more. Buying a long option is a limited risk strategy. Question 32. A registered representative facilitates the sale of a private placement security to a customer outside the scope of their employment with the broker-dealer. This activity is best described as A. Selling away. B. Outside business activity, OBA. C. Private securities transaction. D. A legitimate transaction provided the firm is compensated. Answer A. Selling away. When a registered representative sells securities to a customer outside the regular business and supervision of their employing broker-dealer, it is often referred to as selling away, or formally, a private securities transaction. This activity is a serious violation of FINRA rules unless the representative has provided prior written notice to the firm. If the representative receives compensation, the firm must also approve the transaction and record it on its books. The keyword facilitates the sale, outside the scope of their employment, is the definition of this prohibited activity. Question 33. In a margin account, the hypothecation agreement primarily serves to A. Limit the total number of shares the customer can purchase on margin. B. Allow the broker-dealer to lend the customers fully paid-for securities to other customers. C. Authorize the broker-dealer to rehypothecate, pledge, the customer's margin securities as collateral for a bank loan. D. Set the minimum equity required in the customer's account before a margin call is issued. Answer. C. Authorize the broker-dealer to rehypothecate, pledge, the customer's margin securities as collateral for a bank loan. A margin account requires the customer to sign 3 agreements, one of which is the hypothecation agreement, which is a key concept on the SIE. This agreement is essential because it permits the broker-dealer to rehypothecate or pledge the customer's margin securities, up to 140% of the debit balance, to a bank as collateral for the loan the broker-dealer takes to finance the customer's margin purchase. This process is necessary for the broker-dealer to obtain the funds it lends to the customer. Remember that the hypothecation agreement allows the firm to use the customer's margin securities as collateral. Question 34. The primary role of a transfer agent for a corporation's stock is to A. Handle the issuance, cancellation, and exchange of stock certificates and maintain the list of registered shareholders. B. Buy and sell the stock in the secondary market to maintain liquidity. C. Calculate the net asset value, NAV, for mutual funds. D. Ensure the corporation complies with all federal and state securities laws. Answer. A. Handle the issuance, cancellation, and exchange of stock certificates and maintain the list of registered shareholders. The transfer agent is a specialized agent for the corporation whose primary responsibilities include maintaining the official record of all shareholder names and addresses, ensuring that the total number of outstanding shares does not exceed the authorized amount, and handling the logistics of stock transfers, such as the issuance and cancellation of certificates. Another function is to mail corporate communications to the stockholders on behalf of the issuer. The core concept is that the transfer agent is the record keeper and transfer facilitator for the issuer's outstanding securities. Question 35. During the cooling-off period of a new securities offering, a tombstone ad may be used by the underwriter for what purpose? A. To solicit indications of interest from potential investors. B. To finalize the sale of the new security to customers. C. To advertise the security's final offering price and effective date. D. To distribute a statutory prospectus to the public. Answer. A. To solicit indications of interest from potential investors. A tombstone advertisement is a permitted form of communication during the cooling-off period because it is not considered an offer to sell and is simply intended to announce the existence of a new issue. The ad contains basic information about the issuer, the security, and the underwriters, and it clearly states that the ad is not an offer to sell. The purpose is to solicit indications of interest from potential buyers, which are non-binding expressions of interest, not actual orders. Remember that while tombstone ads can solicit interest, they cannot be used to confirm sales or advertise the final price until the effective date.